I'll start with Patrick, of course. Good afternoon and welcome to the Appropriations Committee. This afternoon, we are having an Appropriations Committee meeting, a budget hearing on basically state public debt, which is an important piece of the budget that we try to construct and pass. We're going to have today with us Patrick Frank, who is the budget analyst, and we are really thrilled, and I want to say this very publicly, to have Mr. Derek E. Davis, who is our new state treasurer. For those in the public who are watching that you don't know, Derek was a very esteemed member of this body for many years, for almost 20 years. He was the chair of the Economic Matters Committee, and we're so pleased that this is his first appearance today in front of Appropriations Committee. Derek, I want to tell you that I've told people around this office that I came this close to calling up, human services, or the human, or whatever it is that does our paychecks, our payroll, and say, can I have my payroll, my check now mailed to me? Because I want to see your signature on all these checks, okay? But I'm not doing that. It's going directly into my bank account. But I want you to know, it crossed my mind that I'd like to see that signature. So everybody in the state of Maryland knows who Derek Davis is when their paycheck comes in. So we welcome you, and we sincerely welcome you, and we sincerely want you to know that we are a partner with you in the state of Maryland. So with that, I'll call up Patrick Frank.
You should be able to see the screen now for the public debt analysis. As the public debt, basically that pays the debt service on the GO bonds, which is the state's capital program. I'll quickly go through. So I'll skip a few of the exhibits here, but I'm happy to answer any questions if anybody wants more detail. I'll start with this first exhibit here, which shows how what the debt service payments are. Basically, you can see over 2/3 of the debt service payment is principal, and a little bit under 1/3 is interest. The reason for this is Maryland state bonds are limited to be only 15 years. The average maturity is 10 years. This is a pretty quick maturity. So what the state does is it pays the principal down more quickly, which means you have higher principal payments and less interest costs. Okay, I'll skip on to, let's go right to what pays for the debt service. The primary thing that pays for the debt service is the state property tax. And what this shows here is something probably everybody knows. This green line is what the median sales price has been in the last 17 years. And as you can see, after dipping, in the Great Recession, it's been steadily increasing, but it does look like it's increasing at a higher rate in recent years, and that is probably no surprise to anyone. Inventories have been down a little bit, probably not a surprise to anyone either. So with that, we put together a forecast for what the debt service is going to be and what the state property tax are going to be. And as you can see, the green line, the debt service is higher than the state property tax. That's a decision that's been made that in order to keep property taxes low, the rate has been 11.2 cents per $100 of assessable base since about 2005. The rest of this is paid for by either bond premiums or more commonly general funds. And so with that, we put together a general fund, or excuse me, an annuity bond fund forecast. So you can see here some of the important lines. Here's our property tax receipts, what we are expecting from them. We do have some bond sale premiums that we're using, a lot of which is going into the capital program, but some is going to pay for the debt service. We're starting, we expect to start 2023 with about $150 million fund balance, which also helps. I mean, sorry, a $48 million fund balance. And so then we get about a $430 million general fund payment that we need. It's interesting too here, this is using the governor's budget books, and I expect about a $24 million fund balance in the annuity bond fund at the end of 2023. And that may be very helpful, because the first issue relates to the bond sale, that we usually have bond sales in about March and in August, so twice a year. What the treasurer has proposed is, instead of having two bond sales, they're going to have one bond sale in May or June of this year. And so it'll be essentially twice as big as a normal bond sale would be. The short version of this is there really are no consequential long-term effects of this. This is just changing the timing of the payments. It may help in that one of the issues that the state has is there's something called arbitrage rebates. Sometimes people ask, why don't we just issue a massive amount of bonds, and then while the rates are low, and then we'll be financing projects at a really cheap rate. Well, the IRS has rules about what you could do with tax-exempt bonds, and they don't want us holding on to a lot of cash. And so if you don't spend down your bonds quickly enough, there are some arbitrage rebates you have to pay. So this, there's a very much a cash flow issue with the bonds, because you want to issue them when you need them for your capital projects. There could be some short-term effects from having the larger bond sale in fiscal 2022. The reason is bonds pay their debt service payments every 6 months. And so, for example, in an August bond sale, you'd have the first payment would be in February and the second would be following August. So you would only have one debt service payment in that year. However, and we did this in 2016 also, is we had a one large bond sale. And what happens then is, if you do it in May, what you'll do is you'll have your first debt service payment in November and your second in May. So you would have two debt service payments during the fiscal year. So we would calculate that would be about, say, $13 million more that you'd have to pay in 2023. But as I said earlier, this is just moving up the cash flows. The bonds don't cost more. You just sold them sooner, and so you'll be paying them off sooner. And so, like I said, no long-term effects, but it could increase 2023 costs. And that's why that $24 million fund balance may be helpful, because if there is enough money to do that in the account now. Second issue has to do with why. The next two issues really are going to be about why do we sell bonds, and obviously they support the capital program. And one way these bonds are supporting the capital program is the bonds are selling at a premium and have been in recent years. What that essentially means is that the proceeds from the bond sale are more than the par value of the bond sale. The trade-off here is that the buyers of the bonds give us more capital up front, and then we give them larger debt service payments throughout the period. It doesn't really change how much a bond costs the state as far as the yield on the bond, but it does, once again, everything seems to be about cash flow in this budget, and it does change how the cash flows work. And what this governor's proposing in his budget with these bond sale premiums that he expects to be $230 million is using $210 million to support capital projects. And that money is actually in the capital budget right now, and the one that was submitted. And there would leave another $20 million in the account, in the annuity bond fund account. What would happen with that money is either it gets used to pay for debt service, or it could be reused at a later date for more projects. But if you're going to do this, I think it's important to understand what the implications are. And one of the things to understand is really this is all about interest rates. And what this chart shows is the 10-year US Treasury note rate since 1962. The reason I selected 10 years is because I said earlier, the average maturity of a Maryland bond is 10 years. So this matches up nicely. This is the longest series I was able to find. It's from the Federal Reserve. And what's amazing about this is if you look here, you can see this line here is the beginning of the COVID-19 pandemic response in March. And you can see that those rates, interest rates, are incredibly low, lower than at any other time. The last bond sale we had in August had one of the lowest rates ever that we sold bonds for, and every rate that was lower was a bond sold was in a week during the pandemic. So I mean, these are unbelievably low rates, and they probably aren't going to stay that way, and they're already moving upward. So what we expect is interest rates to rise, to increase. And what we also do is there's a couple of firms that we buy forecasts from about interest rates. And here they are IHS Markit and Moody's Analytics. And here you can see what their interest rate forecasts are. And as you can see, they diverge a little bit. The green, the IHS Markit, a big part of that is they don't expect as much inflation. And that's really a big part of what this is. This is as much of anything as an insight into what the inflationary expectations are. So if you think inflation is going to be higher and you're worried about inflation, you're probably thinking interest rates are going to be higher. If you're less worried about inflation and you think that it'll moderate, and then you're less concerned. But anyway, those are the two. And what I did with those is I modeled using all the same the data with what the size of the bond sale is, and I modeled the June or the May-June sale that's coming up, and also the March sale of next year, just get a sense of what we think the bond sale premiums could be based on forecasts. And as you can see here, depending on which interest rate forecast you use, we expect between $343 and $372 million of bond sale premiums. The budget has 244 in them already. $34 million were from last year's budget bill that anticipated them, and we expect to get that $34 million in this upcoming sale. And then there's $210 million, as I mentioned earlier, that's in this year's capital budget. Now, that said, there's a lot of other variables that could change. And so I'm kind of hedging my bets here, because I do think that these bond sale premium estimates can be wildly off. And here's an example of how they can be different. Other factors that affect the how much premium you get is what's called the coupon rate. And that's the rate that's published on the bond. Say it's usually about 5% for Maryland bonds. And the other is if you reduce how much you sell, you get less proceeds. And part of the proceeds obviously is the premium, so you get less premium. And so I said, well, what happens if the coupon rates are just 0.5% lower than instead of 5% or 4.5%? Well, that takes about almost between $65 and $70 million off of the bond sale. And now, just for some perspective, before the pandemic, there was a bond sale that had a coupon rate of about, I think it's like 3.9% or something like that. So that rate would have probably taken, $130, $140 off of the premium if that rate were used. Similarly, the bonds, the treasurer decides how much to sell based on cash flow needs. And there's surveys that are done, and if the cash flow needs are less, well, then the bond sale will be smaller. So what's happening here is if you just take two of those two factors, that kind of reduces the range a bit more on what we think about $90 to $100 million less of premium that we would get. The next issue has to do with the affordability ratios. This is another important thing. We do have two ratios. One is that debt service not exceed 8% of state revenues, and the other is that debt outstanding not exceed 4% of the personal income of the state. What we see here is something pretty remarkable. And for years, we've been close to that 8%. And now we're actually below 7% and are heading down, so that we're, 6 3/8% is basically what we expect at the end of the forecast period with this. This is pretty low. I mean, I remember what happened was with the 2000, I think it was about 2010 with the Great Recession, these ratios were so high that the administration at the time took over $250,000 out of the capital program because there would have resulted a breach in the ratio. So we think that this is pretty amazing, and we're fortunate to be here. This means there is capacity, and so more obviously could be authorized. That's a decision for you to make than you want, but there is certainly capacity here. And let's see the other ratio. This is one we tend to be comfortably under. One reason for that, as I said earlier, we have high principal payments. We retire our debt early, so our debt outstanding tends to decline more quickly than most other states. Okay, let's see. Now, next point I want to make, and this issue has to do with how does Maryland's debt compare to other states, and especially other AAA rated states. And so this first exhibit here, exhibit 15, it shows all the AAA rated states, the mean debt outstanding to personal income ratio, and how Maryland ranks. And as you can see, we're second highest among the AAA rated states. And what's interesting is that even with how quickly we amortize debt, we still have, we're very high in this table. It's interesting that there are only 3 states that are above the mean of the AAA rated states. Most of them are below the mean. And the next one, I compare similarly to what's debt service to revenues. And this one, Maryland, is the highest ranked of the AAA rated states. So it's kind of interesting that, you know, I was expecting this one us to be higher in this one than the debt outstanding ratio because we tend to have higher debt service payments and we so we amortize our debt more quickly. But it's interesting that we are that high. So we definitely are a high debt state. And I guess you got to ask yourself, why is this the case? And if you just look at the capital program, this is this year's capital program, about 39% of the capital program that we have this year is for non-state facilities and programs. So we use our capital program, as everyone I'm sure in this committee knows, to pay for a lot of other needs that the state has. And so as a result, we issue more debt, and we do more of that than other states do. I also would like to point out that the Stadium Authority is also issuing a fair amount of debt. And I'm sure that's something that everybody in this committee knows as well. And here's a list that shows all the prior authorizations that we have from the Stadium Authority. As you can see there, there's Built to Learn, the Baltimore City School Program, there's the money for Pimlico and Laurel Park, and so this could get a little bigger this year. There is a bill to increase the Camden State area with baseball and football stadiums to $1.2 billion. So that would be another $965 million of authorization. And also there's a bill for $200 million for some minor league stadiums around the state. And those are bills that are being considered now. A final exhibit that I want to show you has to do here with depreciation rates and capital assets. This relates to that whole facility renewal program. And this really goes to show you that Maryland has a lot of aging infrastructure that the state owns, and among the highest. Once again, I'm comparing the AAA rated states, and here only Indiana has in a sense more depreciated state infrastructure than the state of Maryland does. And so I guess what I'm saying is it's very wise to put extra money into the facilities maintenance program. Finally, my recommendation is to concur with the governor's allowance. And finally, there is, for anybody who's more interested in bond sale premiums, here's an example of why we get them, how they work, and it comes with a little example from an old bond sale showing the benefits to the bondholder for selling or buying bonds at a premium if interest rates rise. And with that, I will conclude my remarks and take questions.
Thank you. We have a couple of questions I see already, but going back to the Camden Yards, the state stadiums, when's the last time that debt service was increased for them?
You know, it's been so long that I can't tell you quickly what it is. I'm going to say it would have been the Raven Stadium when it was built, well, before it was built. But we're talking about that era.
Right. Okay. Delegate, we'll go to questions of the analyst. Delegate Smith.
Thank you, Madam Chair. And thank you, Patrick, for a very comprehensive presentation. I'm a little new here, so I want to just go back to, I think, Exhibit 17, when you were discussing kind of what the general obligation program supports in terms of projects. I didn't know if you can maybe kind of unpack what, like, some examples of what that means, particularly, you know, the non-state facilities and so forth.
Okay, certainly. Basically, there's three different categories here. The higher education facilities would be USM. I guess Baltimore City Community College would consider as well, and things like that. The state facilities would be the state hospitals, state buildings, it's state property basically. And finally, the non-state facilities, that is things like the public school construction is probably the largest in that category. There are many, Matt Klein is much more versed in these things than I do, but it's all those programs for groups. I mean, housing would be in here as well. There may be some environmental things that possibly that could be in here that maybe isn't a state-owned facility. But yeah, it is a lot of those kinds of things.
Thank you so much for that. Pretty diverse. Thank you, Patrick. And things that are essentially like shovel ready is kind of the frame, maybe.
Yeah, I mean, sometimes it's design ready, if you will, and sometimes, but yeah, you like to think that that there has been a lot of some thought has gone into how the money is going to be spent and what they're going to do with it before they get it.
Thank you so much, Patrick.
You're welcome.
Thank you, Delegate Henson.
Madam Chair, and thank you, Patrick, for a very thorough presentation. I was trying to see if there was any relationship between Exhibits 8 and Exhibit 10. Exhibit 8 seems to show that our interest rates are at what looks like an all-time low. And then Exhibit 10 shows that by both of the analytics companies that they will be trending upward. Does that mean that now is a good time to authorize new debt, or how should we be viewing that?
Yeah, good question.
Well, I would say it's kind of they're different indices, but it's kind of a before and after. The Exhibit 8 shows everything that's happened. So this is, I think, through January of 2022. This stops last month. The diverging forecast that starts in the first quarter of 2022, which is January, February, and March, and then takes an estimate moving forward. So, and basically what it is that the future hasn't happened yet. So it's really hard to make estimates sometimes. And what we do is to get some different points of view and some people who spend their full-time job doing this. We got some forecasts from them just to kind of see what are expectations from people. So yeah, they expect them to rise. I would say you want to authorize debt smartly. And one of the reasons we have like the ratio, the affordability ratios is so that, we have some limits on our debt, and so that the program doesn't become so large that it crowds out things like education or healthcare or housing or other important priorities. Because if every dollar you spend on debt is a dollar that doesn't go to the operating budget and operating priorities. And so, but I think the authorizations really ought to very much what do you see the needs are? And what I didn't say too much about is the rating agencies kind of look at what the state is doing, how the state is spending its money, and what kind of a process it has for deciding how to spend its capital money. And one of the things that Maryland has done in the past is a very transparent process with the Capital Debt Affordability Committee, and the state really tries to manage this effectively. And it comes down to what your needs are. And so I would say, just to authorize what you think is appropriate within limits, and thinking about downstream effects of that you don't want to have debt crowding out too much. I hope that wasn't too long an answer.
Thank you. I appreciate it. Thank you, Madam Chair.
You're welcome. And I will say, Patrick, I did have, just an urge to call former Senator Serafini when you were going through the 8% debt ratio. I remember, was an expert on lecturing all of us on that 8% cap. We'll go now to Delegate Valentino Smith.
Thank you, Madam Chair. And this may be just having Patrick clarify a little bit from what he just did for the good delegate from Anne Arundel County. So on page 2, where you put your key observations, good observations, and you're really highlighting for us in the last one that Maryland is a high debt state that's expanded its capital program beyond state facilities, but we still have the AAA bond rating. And then you gave us exhibits 15 and 16 to show us how we're standing with the rest of the AAA ranked states. And so I'm interpreting from this that everything is going swell and that we're not jeopardizing our AAA bond rating, and notwithstanding the fact that we have a higher net debt outstanding percent of personal income and as a percent of revenues. Is that fair?
Yes, I would say that, but I would add, in past analyses, I've added a section about had more comments about this. But I guess what I would also say is if you're a high debt state, you may get scrutinized a lot more than if you don't issue much debt. And I think one of the points I've tried to make in the past is that as a high debt state, we probably are being scrutinized more. And so therefore we should be very transparent about our policies. And what I've recommended in the past is to have a growth rate, to kind of decide on a growth rate. For a while it was 1%. Now I think the spending affordability looks at our revenues and says, let's go to 4%. And to make policies like that and to kind of stick with them for a few years as the situation changes, you adapt your policies to meet the needs. Sometimes we don't have a lot of money and other times we have more money. And so that is kind of, I don't know if that clarifies that.
No, thank you. Thank you, Madam Chair.
You're welcome. I think we're one of the few states that does school construction. Public school construction. Am I right, Patrick? Oop, you're on mute. You're on mute.
Okay. There we go. Sorry.
That's all right.
Yeah, we're definitely one of the few. I've never surveyed the other states, so I can't give you any statistics on who does it, but I know the extent to which we give it is certainly unusual.
I actually now U.S. Senator Cardin, I think this was started when he was Speaker of the House, and he mentioned this the other day to the Baltimore City delegation. Delegate, the Vice Chair, Chang.
Thank you very much, Madam Chair. Good afternoon, Mr. Frank. Thank you very much for the presentation. It really highlights the robust investments of infrastructure that we've been making all across the state. And also it's interesting to see how the actions that this body has taken with the bond premiums, how that has offered additional capacity and additional investments within the program. Last year, we had made a decision to increase the public debt program by 3%. And I was wondering if you could let us know where we are with that plan and where we are presently with the debt program. Thank you very much.
Yeah, I guess what I would say where we are with the debt program, as far as our ratios are concerned, I think the best chart is this one right here. This factors in, basically what this chart does is it takes into factors what the Spending Affordability Committee recommended and uses that moving forward. And so with those, it shows that we stay under 7%, which is a percentage under the 8% limit. And so this shows that what Spending Affordability recommended is affordable, and it'll keep us comfortably below our limits.
So, Mr. Frank, how do you feel about the 1.5 affordability, where we're at with that?
But I'm sorry, what do you mean by the 1.5?
Where we are with the decision for the $1.545 billion with regards to that limit.
Oh, you mean authorizing an additional 1.5 billion?
Correct.
Okay, gotcha. I did run some scenarios about what would happen if you increased it, and that amount is still affordable under our ratios. It is, you can't do that every year, but we could certainly do that this year.
Great. Thank you very much, Mr. Frank.
Delegate Barnes, Chair of the Capitol.
Thank you, Madam Chair, and thank you, Patrick Frank, for the great presentation. I kind of want to get in with where the Vice Chair was a little bit. If we can just dig a little deeper. So I know that we had talked about 1% and a 3% at times and a 4% inflationary sort of increase at SAC. If we had kept pace with those, because we've been artificially sort of staying neutral on those the last few years, I think we talked about at SAC, we'd be about 1.46 or somewhere in that range now.
Yeah.
Correct.
That's what you have. Okay. So I do also want to talk a little bit about those affordability ratios because, as chair of the capital budget, I sit on CDAC, and the staff at CDAC this fall talked about, given the fiscal outlook, there is virtually no reasonable number that is not affordable at this point. And they talked about a number as high as 2.5 billion at CDAC this fall. And I think, again, that was echoed at SAC that, our number, I know the vice chair talked about a fairly reasonable number at 1.5, but our number could go, well higher than that and would still stay within those affordability ratios. Is that something your analysis also concurs with?
Yeah, what I would say is just to clarify, if you go to the 1.5, you can do, and then as a new base moving forward, I think at this point,
Right.
but
And
something
1.5
once you
seems
get
to
to
be
the
a number that
Pardon?
makes a lot of sense, given that would be around the number that we had if we had just kept pace with inflation. And we know inflation has really been through the roof the last year, but if we just kept pace with even that 1% or 3%, that would be around that number at 1.5. And I guess I'll just editorialize that. Look, with the governor putting in over $2 billion between PAYGO and capital in capital, PAYGO and GEO in capital spending, he certainly is a leader in the state and has apt ability to sort of identify capital projects, but so do the 188 legislators. And he's put in 2.1 billion and left us with 50. And so I do think with the analysis you've given us and what this committee has identified, that we can certainly 1.5 would stay within the affordability. And I appreciate you concurring with that.
Thank you. I don't see any other questions. I'm going to summarize a little bit if you don't mind. Thank you, Patrick, for your presentation. And let me just say to the Appropriations Committee, last year, probably about this time, I said to you, all of you, each of you as members, that I was really looking forward to and hoping that we would put together a robust capital program that would help all of us out, and that we could afford it and we should do it. And I wanted to work very closely with the Senate, and I wanted to work very closely with the governor's office. I'm going to tell you the same thing this year. That's what I hope to accomplish. I really do. I do think, based on Patrick's presentation, based on what I've heard, there is no reason, really, that I can name that we should not have as robust a capital program as we did last year. We should be doing something close to that or slightly more than that this year. It's the year we should do that. I do want input from all of you, each of you on this committee. And in particular, and I am not trying to point out anyone in particular, but I will say that to the members of the Republican Party on this committee, I would like your input. I would like for you to let me know if you have any reservations at all about moving forward with the kind of capital budget we were able to provide last year, and having us work hopefully in collaboration with the Senate and the governor. If there's any issue with that, please let me know. And Delegate Grice, in particular, I think a conversation with you would be important, so that I can be clear about what our marching orders are in this committee. With that, I just want to thank again our analyst and say you did a great job, Patrick, as always. And now I do want to bring up agency representatives, and I want to welcome again the new treasurer of the state of Maryland, Delegate Derek Davis, and also Jonathan Martin and Kate Allen, who's on the legal division director of the council, to the treasurer. If you have any remarks that you want to make.
Thank you very much, Madam Chair and members of the House Appropriations Committee. First of all, I just want to remind you all what I said on the rostrum when I was sworn in as treasurer, or when I was elected treasurer. There will be no hazing today, okay? None of that. Let me start by saying, Madam Chair, first of all, I want to thank Mr. Frank as well and DLS for a very thorough job and analysis of some complicated issues I'm certainly getting my arms around and learning about every day. So I wanted to thank him for all that he did, as well as DLS. Also, the State Treasurer's Office does concur with the governor's allowance and the DLS recommendation. I was going to address 3 points, but I would be repeating them at this point. Mr. Frank hit them all. So what I'd like to do, you all have my full written testimony, so I won't go through that, but I wanted to highlight it because I heard Delegate Henson allude to it, as well as Delegate Valentino Smith, as it relates to Maryland's debt. And I'm sure you all know all of this, and it's newer to me, but I'm going to say it anyway. I've been meeting with the rating agencies, Moody's, Standard & Poor's, Fitch, and we've had a very good discussion about Maryland's debt. And to be perfectly honest with you, while they do mention it, you know, and from a qualitative or quantitative standpoint, they have some concern. That concern is overridden by a couple of things. And just so I get it correct, it's on page 2 on the overview of Maryland's credit in my written testimony. They note that there's broad consensus about Maryland's strengths and challenges. Our strengths include our strong fiscal management institutions, and they're talking about capital debt, affordability, and the Board of Revenue Estimates and so forth. They talk about our long track record of excellent fiscal management, our stable, diverse economy, and our highly educated, well-compensated population. So while I don't want to say that, you know, that they aren't, that they aren't paying attention to it at all, they've emphasized to me, because I've asked them that, because I was going to communicate whatever I found to you all, that that concern, any concern there is overridden by those factors, and that Maryland is firmly a AAA state. And as you noted, Madam Chair, I believe it was you, as it relates to school construction, we as a state carry that as opposed, the bulk of it anyway, as opposed to the locals. And rating agencies have told me they realize that quirk, that in terms of Maryland doing that, that's really not that common throughout the country. So they are, they're aware of that, and they take that into consideration when they're looking at our debt and our overall rating. So I'm here, basically, I said all of that to say, I believe we're in excellent shape. We certainly have, I told them if they have any questions, concerns, or anything, to give me a call. We will make sure that they have all the information that they need. And, I wanted to keep that same relationship with them that Treasurer Kopp had, and they were receptive to it. So, you guys are doing a great job, and Maryland's in good hands.
Thank you. Does anyone have a question for the new treasurer?
Of course.
Wait a minute. I think this is about the extent to you're going to be hazed. Okay.
Understand.
Thank you very much.
Thank you. Thank you.
We appreciate you being here. First timers, they get it every time. I tell you, you can count on us. Does Mr. Martin or Miss Allen want to add anything?
Mr. Martin had a family emergency, so he's unable to be with us today.
Okay. Miss Allen, anything?
No, I'm fine. Thank you very much.
Good. Thank you. And thank you for your first appearance. All right.
Thank you.
The second one, you have to answer all those hands,
I understand.
Yeah. So you have a great day. And committee, thank you very much. And thanks for the flexibility on changing the time. We did want to make sure that Treasurer Davis was here. Thank you. Have a great afternoon.
Thanks, everybody.